Today, you guys will be learning about candlesticks. The Japanese began using technical analysis to trade rice in the 17th century. While this early version of technical analysis was different from the US version initiated by Charles Dow 1900, many of the guiding principles were very similar. The what price action is more important than the why, news, earnings, and so on. All known information is reflected in the price. Buyers and sellers move markets based on expectations and emotions, fear and greed. Markets fluctuate. The actual price may not reflect the underlying value. So we're hopping right into it. So as of day 2, you guys will be jumping off the porch ASAP, right? So can you guys see my mouse? You guys can see my mouse, right? Okay, cool. So I'm going to go over what makes a candlestick green and what makes a candlestick red. And before I do, how many people say me if you do not know anything about candlesticks? I just want to judge real quick. Not judge, but see what's, oh, wow. Okay. Cool. A lot of people don't know anything about candlesticks. So this is going to be awesome for me. Believe it or not, guys, what is this? AMU, we're approaching our year anniversary, but really you guys are going to be our 1-year anniversary. This is my first time asking that question. I never asked anybody the last 12 courses. This is the 12th one we've done. I never asked them did they understand it beforehand, but for now on, I'll make it my business to do so. So the next question I want to ask on a birthday is all I got. Okay, happy birthday. All right, so nah, you're not late. You're good. So I want to ask this next question. Say me if you do know candlesticks. Okay, so half the class doesn't. I'm pretty sure these people are in my chat. Okay, cool. So these people know what candlesticks are. They said, yep. Okay. So that is why, because they've already dabbled in the market, and they're pretty much, these people in my chat are trying to get to the later days. I would say half the class, well, it's going to get advanced pretty soon, don't get me wrong, but I would say 7 through 12 is when it gets very advanced. You know, half is us kind of like just getting you into the market. And then the last part is just us shoving down all the advanced strategies, the last half, all the advanced strategies we have. All right. So let's get right into it. I want to be very interactive. So this is a green candlestick, right? And every candlestick, when you're looking at a chart, right? So if I was to go to a chart, you will see that every candlestick represents its time frame. So if we're on the 5-minute chart, every candlestick represents 5 minutes. If we're on the 15-minute chart, every candlestick represents 15 minutes. Daily chart, every candlestick represents 1 day, right? So when you're looking at a candlestick, you're looking at the relationship of what happened depending on what chart you're looking at. So if you're looking at the 5-minute chart, you're going to be able to see what happened every 5 minutes. If you're looking at the 15-minute chart, you're going to be able to judge and see what happened every 15 minutes. So that's pretty much what a candlestick is showing us. Human emotions, or not even human emotions, stock market type emotions based on the time frame, right? So if we're looking at the 5-minute candlestick right here, right? Let's just say this is 5 minutes or 1 day. We could say 1 day, okay? So within 1 day, it opened here, went as low as here, went as high as here, but closed here, right? So what does that mean? In order for it to be a green candlestick, the close must be higher than the opening price. Oops. Sorry, my Ring camera. But in order for it to be a green candlestick, the close must be higher than the opening price, and vice versa for it to be a red candlestick. The close must be lower than the opening price. So let's just say it's 5 minutes, right? as soon as the 5 minutes open, right? Within 5 minutes, it opened here, right? The price, let's just say, let me get my little notes out just to make sure you guys get this. Okay, I'm going to be drawing something, right? So let's just say it opened at 1, right? Then it went as low as 0, right? And then it went as high as, let's say 4, but it closed at 3, right? So that would be kind of what a candlestick would look like, right? Within 5 minutes, it opened here, when as low as here, when as high as here, but closed here, right? And then vice versa with here, right? It would have opened vice versa. Okay, let's just say it opened at, let me see, we can say something like, okay, highest is 6, right? But it opened at, let's just say a 5, right? And then when it's low as like a 2, but then close at like a 3, right? So that's kind of how a red candlestick would look. Does everyone understand what I just did there? Put a yes. It's all about the relationship between the open and the close. And the relationship between the open and the close price is called your real body, right? So the relationship between the open and the close is called your real body. All right. That's cool because I'm going to go slow with this one. Okay, compared to traditional bar charts, many traders consider candlestick charts more visibly appealing and easier to interpret. Each candlestick provides a simple, visibly appealing picture of price action. A trader can constantly compare the relationship between the open, close, as well as the high and low. The relationship between the open and close is considered vital information and forms the essence of candlesticks. So, long green candlesticks show strong buying pressure. The longer the green candlestick is, the further from the close is above the open. So basically, big candlesticks represent big buying pressure, right? So if we're looking at this candlestick, I don't even have to see where it opened or closed because I understand the relationship, right? If it's a green candlestick, that means the opening price or the opening price, right? The close is higher than the opening price. So this would be the close. And if I'm looking at this, if it's a green candlestick, it opened here, when as low as here, when as high as here, but close here, and vice versa. I know if it's a red candlestick, the close is lower than the opening price. And here's the highest and the lowest point. The only thing that doesn't change is the highs and the lows. The highs will always be above and the lows will always be below. But other than that, you're watching the relationship between the open and close to form the essence of the real body. The real body is the relationship between the open and closing prices. So when you see long upper shadows, that indicates when some type of reversal, right? So that means sellers came back in control, right? So if I'm looking at this, right? If this is a red upside down long candlestick, right? So I will see that for one is red. So that means the close is lower than the opening price. So it opened here, was green at first. So this was a long green candlestick because remember, it opened here, then it was green, but sellers came back to push the prices down. And then when they pushed it down, it went lower than the opening price. Oops. It went lower than the opening price and then went as low as here, but closed here, right? And then vice versa here. This was once a red candlestick because it opened here, and then sellers pushed the prices all the way down here. And then buyers came back in control to push the prices up. And then it not only did they come back in control, but they even surpassed the opening price, came all the way back and closed here. So that is why these two candlestick patterns are going to be the most powerful because of how much work it took for all of this to happen. It wants, and I'll explain that in a few more slides as to why these two candlesticks patterns are single-handedly powerful. So now we're going to look at the relationship between the 5-minute chart and the daily chart, right? So here is the relationship. All of these candlesticks represent 5 minutes. All of these, right? Oh, let me go tell them to be quiet real quick. Sorry, my family's downstairs. But anyways, I had to tell them I'm doing AMU. But anyways, all of these are 5-minute candles, right? So this is after hours pre-market. This is the close, and all of these are 5 minutes from 9:30 to 4, all of this. So right now I'm using military time, so don't really mind me, but this is from 9:30 all the way to 4 p.m. 1600, right? How many military are in here, by the way? Say Hull. Just type Hull and be honest. Don't be no fake. Not no basic training and I quit. Who passed basic training at AIT? They talking about some big Hull. Okay. Cool. All right. God bless all of you. All right. And where are all of you stationed right now? Let's see something real quick. Fort Hood, Kuwait, Bragg, Elgin, Separated, Bragg, Pentagon. Oh, that guy's it's going crazy. Fort Dix, JBSA, Quantico. These people got CC. They got some big money people here. They stationed in the good places, the well-connected, well talkers. When you see people stationed at places other than like the norm, they connected, they did a little something, and some get lucky, but it usually be the connected people. Military people know what I'm talking about. But anyways, so within a day, right? It opened here, buyers push the prices up, right? So it opened here, but buyers pushed the prices up, but then sellers came back in control. Oops. Sellers came back in control. And then it went as low as about right here, but then it came back up to close here. So what does that candlestick look like? This on the daily chart. So within 5 minutes in one day, all these represent 5 minutes. This was the outcome because of what you see here. One, it opened here, then they push the prices up. So if I was to do this, let me see, I would do a yellow, right? So step one is it open here, right? Then step two, buyers push the prices up, right? And then step three, sellers came back in control with this little wick you see right here, right? And then step four, it closed here. But it also went as low as right here, right? So that's pretty much how you see a can. And honestly, sometimes I can tell, well, you'll be able to tell the more experience you get, you'll be able to tell how a candlestick looks based on charts, So candlesticks with long upper shadows, long lower shadows, and small real body are called spinning tops. Even though the session opened and closed with little change, prices moved significantly higher and lower in the meantime. Neither buyers nor sellers could gain the upper hand, and the result was a standoff. So here you see bullish spinning top, right? And what you see is the close and the opening price was kind of similar, but it has two long wicks, right? So it's just a little spinning top. You know what these spinning tops remind me of? That movie Inception. I remember when I was little, I always get this little image of Leonardo DiCaprio and that little spinning top. Who knows what I'm talking about? The Inception movie or whatever that was. And he's spinning the little top or whatnot. So am I saying the movie right? Yeah, Inception. So That's how you kind of got to think of spinning tops. It's just very indecisive, very confusing. So imagine if, okay, everything is going down, right? So these three guys right here, they think everything is going down. And then the fourth guy, he's just all confused. He doesn't know if he wants to be red or green. And the next thing you know, he's just standing still. He's at a standoff. What that does is that's a sign of slowing momentum. So that's why candlesticks are used for psychology purposes. And I honestly kind of give a human scenario to every candlestick, and you're going to see that. Like with this one, I kind of think of Inception, and I think of basically after a downtrend, shit just start getting confusing and because of this. And then same here with the uptrend, have a spinning top up top, then that shows slowing of momentum. Now, granted, just because you see these candlestick patterns does not mean they'll work instantly. And I'll explain all of that. And that's something that takes time and experience to kind of judge whether it's going to work or not. And I can tell you guys how and when to look for these candlestick patterns. So dojis form when candlesticks open and close are virtually the same. I keep doing that. The length of the upper lower. So basically, I'm going to explain in my own words, right? So basically, it opened here when it's high is here, when it's low is here, but came back to close at the same price, right? And vice versa with a dragonfly doji, right? It opened here when it's low is here, but came back to close up here. So if you see this at a form of support, that could signal that could be bullish. And this one, it opened here when it's high is here, but the low and the close and all of that kind of look the same, right? So not only is the low of the day, the high, the close too, the real body and everything. And this one, the high of the day and the opening price is the same. And this one is kind of self-explanatory after I just explained these, right? Is this clicking? Everybody, is this clicking? Put a yes. All right, cool. I would hope so. So these are candlestick patterns. Now we're going to get into candlestick patterns. Now, I'm going to go over which ones are high probability because that's what you guys came here to do. We're here to filter out all of the BS because that's really what books are. And that's pretty much the learning curve I had to figure out myself. I learned about everything you could think of, right? But I just didn't know which ones worked. And you know what it took for me? Losing money. That's how I found out what worked and what didn't, but also getting out of stuff early and watching it work because I was too scared to hold. So the stock market, you'll learn in two ways: losing money and missing out on money when you were right. So that is really when you're going to start to learn the most lessons. Am I right or wrong? Can I get an amen, right? So that's how you're going to learn, is when you start missing out on that money, but you knew what to do. And what I'm here to do is kind of block that out, right? So pin bars are the highest probability candlestick pattern, right? Pin bars and hammers are the highest probability candlestick pattern. Now, let me explain why this is called a pin bar and this one is called a hammer. You'll see something very unique about both of them. One, this one doesn't have an upper or lower wick. The pin bars do. So technically, this can't be considered a hammer because it has it has an upper or a lower wick, and this one has an upper wick. Rarely will you see stocks close like this. Now, granted, they do happen, but it usually be low volume, non-option playable stocks. Just keeping it 100. It usually be low volume, non-playable stocks. So bullish pin bar is the most high probability candlestick pattern that I made the most money off of. Like if you've been in my chat, you know. So why is this thing so powerful, right? Because for one, it would be at a downtrend, right? So after a downtrend, next thing you know, you have the bear. So at first, this was just a big old red candlestick, right? Big old red candlestick at first. It was following the trend, right? But next thing you know, a reversal happened, right? So a reversal happened. So it was a downtrend, and then these guys bend their knees and jump as high as they could. And not only they came up to close green. So this is a bullish pin bar, right? And then boom, it takes off, and vice versa. You see a nice big old uptrend, and then next thing you know, it's looking good. At first it's green, and then bears come down to push the prices back down, and now it's red. And below this, so this would be the entries. Let me let you guys on a little secret. Well, it's not really a secret, but this is how you enter them. Draw. Okay, cool. Boom. Oops, they're not letting me do it. Let me get right back to it. Draw a line. There we go. That would be your entry point, right? So, and I will go over this again, but I would enter 15 cents below the low, right? And I would enter 15 cents above the high for a bullish one, right? I would enter about right here, right? And that is where you enter this candlestick pattern. All right, so let's go over bullish candlesticks, right? So Mike will be teaching you guys support and all about support or whatnot. But basically, this is a bullish pin bar, right? And why did it bounce? Because for one, it was already, for one, it's off of a support right here. So I don't know if you guys can see that, but support is your floor. So if I was to draw a line, right, going straight across, boom, you'll see that the pin bar got caught at this nice support. So as you can see these two wicks right here, it always, this is a buyer's level, right? So next thing you know, the pin bar got caught at a nice little level. And then what did it do? It took off the next day and the next day and the next day, and it went crazy after this one pin bar. And to this day, Costco has not been the same after this one pin bar, right? Single-handedly smashed the whole Costco existence, right? So let's go over another example. Let me see if we see more pin bars. You see another one kind of right here too. Yeah, that's it for now. All right, so this is Dollar General. Dollar General owns the most, they own more stores than anybody else in America. Did you guys know that? They have more facilities open or buildings open than McDonald's and Walmart. These guys, crazy, huh? And you want to know why? Because they have stores in rural communities. You see what I'm saying? So if you who's from the country here, you'll know that there's a Dollar General at your town. See, for one, my wife is from the country, so I know this. So I know this for a fact. They don't have McDonald's and Walmarts. They have $1 General. See what I'm saying? Like somebody said, they're everywhere in Alabama. They don't have things like Walmart and McDonald's. They don't use stuff like that, but they do have a Dollar General. And that is why you can look this up. They have the most stores open in America. A lot of people don't even know that. A lot of people in America, if you ask them who has the most stores open, it's probably going to be in the lines of Walmart and McDonald's. I thought it was McDonald's because, you know what I'm saying? Like, it's just how it is. But anyways, somebody said, oh, the country. Yeah, the country. Somebody said, I delivered for Dollar General for 9 years. Facts. They put them anywhere. Boy, I know you was in some crazy locations, man. And this is trading view for charting. But basically, I didn't even have to move this line. Wow, look at that, y'all. I didn't even have to move those lines. That same line, we got a nice little support here, right? Oops, I wish I can grab that line and move it. But yeah, boom. So Dollar General, I want to draw it again though. So let me get my pen out. Undo. And then I'm going to draw a nice little support line going all the way across, right? Boom, right? So right here, you see a nice little support zone for Dollar General get caught on. Then you see a nice bullish pin bar. So even if it's red, as long as it's on some type of support, it's still bullish. So that's another secret I want to tell you guys, right? So boom, Dollar General is bouncing off this support. I could move this line down if I wanted to, but this general line is where things start to bounce. And as you can see, after this pin bar, it went crazy, right? So the next, by the way, does everyone understand pin bars? Put a yes if you understand real quick. Cool. And you guys will learn support literally next. You will learn all about support and resistance next. So this right here is what I think of when I think of an engulfing pattern, right? So what did I just draw there, right? What did I just draw? There we go. My boy Pac-Man. So when you're looking at an engulfing pattern, remember, I always like to make these things human as possible so that I can understand them, right? That is how I understood things. And that's probably why I got so popular quickly teaching the stock market. Because instead of reading this shit word by word, I would be like, hey, this is an engulfing pattern. It reminds me of Pac-Man. It reminds me of, you know what I'm saying? So I just started kind of doing what preachers do, relate the Bible to your everyday life. And that is how preachers get popular, right? That is how people relate to them. So that's pretty much what I was doing, relating the stock market to everyday life. So when I think of bullish engulfing patterns, I'm thinking of this is how things become an engulfing pattern. The body must engulf this body. So even if these wicks were a little longer, right? So even if I was to draw these wicks, let me see if I can draw this thing. Boom. So if I was to draw this wick a little longer, right? This would still count as an engulfing pattern. Why? Because all that matters is the body, right? That's all that matters is the body, right? So it engulfs this and vice versa here. But it has to be the candle on the right side. So the newest candle so the next day must engulf the previous day, or the next minute or the next time period must engulf the previous time period, and boom, it takes off. And then same here, bearish engulfing, boom, it takes off. So this is the second highest probability pattern you can have. And it's kind of self-explanatory when it comes to logic of why this thing takes off. Oh, and I forgot to explain this scenario, because I'm always talking about scenarios real quick. I got to go back to the pin bar and explain this scenario, right? So think of someone bending their knees and jumping as high as they can. When you think about, that's what I think of when I think of pin bars. I think of someone bending down as low as they can and jumping as high as they can, because it just helps me think about it. And then I think about bearish pin bars, like the ones up top. They don't have one here somewhere, but I think of it as like bats hanging from a wall or a cave and just flying down head first. So here you actually see a lot more bullish engulfings. It's one right here, one right here, one right here, and then this is a bearish engulfing right here, but it didn't really go anywhere. So as you can see, this is a bullish engulfing off of support. If I was to draw this line going straight across, I would get a nice line, like something like this, right? Boom. And as you can see, it's bouncing off of this line. And then next thing you know, it ends with a bullish engulfing, and then it takes off. And then here too, bullish engulfing, takes off. Once Pac-Man gets a hold of it, it's a wrap, right? So that's kind of how you got to think of bullish and bearish engulfing patterns. So this right here is a Harami pattern, but it can also mean inside bar. So in Japanese, Harami means pregnant. Didn't somebody say Harami means something in Spanish too? It wasn't this class, but it was last class. They said it meant something in another language. But in Japanese, it means pregnant, right? So basically, you know how the engulfing pattern was this. It had to be this day. But for it to be a inside bar or a Harami pattern, all it has to do, this one has to be now smaller than this one. Now, granted, I personally do not trust these often, but they do work at like supports and resistances, right? They do work in that way, but I'm just not fond to them, because they're not as high probability as, I can swing an engulfing or a pin bar blindly. You know what I'm saying? Be confident. With these, not so much. So I'm just keeping it 100 with you guys. That's my job. And it's not my job, but that's what I want to do. Keep it 100 with you. These aren't going to be your bread and butter. Now, granted, personally, I haven't tried to use them as a bread and butter play, but just keeping it 100 with you. Your bread and butter is going to be those engulfing in those pin bars. So this is Microsoft. Now they do work, but I just don't like them as much as the others. And the entry is above the highs, and I will go over that too. I think next. Yep. So remember, 15 cents above highs. 15 cents above highs. 15 cents above highs, right? So that is how you enter these things. Entries for bearish candlesticks, 15 cents below lows, 15 cents below lows, 15 cents below, right? 15 cents below. So bullish pin bar. This is the entry for it. And remember, I said it can be red. So this is another one that bounced off support. And those are the things you want to look for off moving averages and supports. And I will go over that in a few classes. But basically, that's the entry. And remember, and I also want to let you on another secret. It could be another day ahead of time. It just can't be like 4. So let's just say it didn't break out this day, but it can break out the next day and it will count. So no more than 3 days out is the pattern still valid, right? So here too, here's a bullish engulfing, and look what happened. It went crazy, and then you would have entered here and then held. And of course, I would have had a target of here first, another target of here, and then once it broke those two, it's going up, right? So this is the end of my portion. I hope you guys enjoyed it. I'm going to pass this off to Mike.
Hello, everyone. Welcome to AMU University Day 2. Today, I'm going to be talking about support and resistance, which a lot of you guys already may know what it is. A lot of you may not know what it is, but it is a very important foundation to becoming a successful trader, understanding charts, understanding where stocks reject, why they reject, where they will bounce, why they will bounce, okay? So support and resistance is very important. But before I get started today, I just want to make sure that everyone can see my screen and everyone can hear me well. Perfect. So let's go ahead and get started. By the way, I don't keep the chat open during the actual, when I'm talking, just because it distracts me. So write down, if you do have questions, write them down. And then during the actual question portion after the class, I'll answer. I just don't keep the actual chat open, just so you guys know. So support and resistance. Think of support like standing on a layer of thin ice on a pond that just froze over, right? You can tap it a few times with your feet before it finally gives in and you fall through. Support, also called demand, is what prevents the stock from falling. The support layer or buyers holds the stock from breaking below a certain level. If the level is tapped enough times, buyers begin to step down and the stock collapses through the ice or support. All right. You can also think of support like a floor, right? And if you have a bouncy ball, so if you have a bouncy ball and you start bouncing on the floor, that's going to be your support. The support is the floor. That's where buyers want to hold up a certain price. Okay. Think of resistance like a volcano. There is a buildup of lava and smoke hidden below a large layer of rock, ready to explode with just the right amount of pressure. Resistance, also called supply, is what prevents a stock from rising. The resistance layer or sellers prevents a stock from breaking above a certain level. If the level is pressured enough, like the smoke from a volcano, sellers begin to step down and the stock bursts upward. So you can also think about that if you're bouncing a ball on the roof, on your ceiling, right? If you bounce it enough times, it's going to keep bouncing off, right? But if you throw it hard enough, if you throw the bouncy ball hard enough, then it'll probably break the roof. So that's what resistance is. Resistance is a layer, a wall of sellers that prevents the stock from going up. So most of the time, it's going to bounce off of the resistance until you get enough buying pressure, you get enough buyers to break through that level. And that's what makes the stock continue to rise. Okay. So support is your floor, resistance is your ceiling. Does that make sense? Perfect. Identifying support and resistance. So one thing that you're going to want to do when we start looking at support and resistance levels is starting from high time frames and working your way down. So you can actually find support and resistance levels on the 1 month chart, where literally each candle represents a month of time. And you can also find support and resistance levels on the 1 minute chart, which represents 1 minute of time each candle. Okay. So I recommend you start from high time frames. I like to start on either the weekly or the daily and then work my way down. I like to look at the hourly and then I like to go down and look at the 15-minute and the 5-minute. All right. So work from those high time frames to find those really key macro levels and then work your way down to the lower time frames to start finding micro levels. Okay. Support and resistance does not have to be at exact price levels. They can be zones. All right. So it doesn't have to be at exactly one specific level. You can actually have multiple layers of buyers and sellers within, a very small zone. Okay. This is the most important part about support and resistance though. So after current resistance is broken, it has now become a new support. So let's say the resistance for SQ is 300, okay? If SQ breaks 300, right, that's my resistance. If SQ breaks that 300, then the 300 will now be my new support. So if SQ breaks 300, it goes to 305, 310, whatever, and then starts pulling back, then that old resistance is going to be my new support and vice versa. After current support is broken, it has now become a new resistance. So if BA has a support at 230 or whatever, okay, and it breaks that 230 to the downside, after it breaks that level and it goes down to like 225, it goes up to retest that old support. That is now going to be the new resistance. Does that make sense? It's like if you throw a bouncy ball very hard through the roof. That was your old resistance, but now that the bouncy ball is on the other side of the drywall, now that's going to be our support. That's where our ball is going to bounce, okay? Personally, for day trading, I like to start with the 1 hour chart and work my way from there to the 15-minute chart and then to the 5. Comparing each time frame gives you a bigger picture on the final outcome. So I'll be talking about the 1 hour chart quite a bit throughout the course. I really like the 1 hour chart. You can see a lot of information on there. It's also called the 60-minute chart, okay? One rule of thumb I've learned over the years is that the more time a stock touches a support resistance, the stronger that level becomes. Let's say, for example, if Apple touches 210 5 separate times and bounces each time, right? So if it rejects that level 5 different times, that is way stronger than if it only touches it twice and bounces, okay? Now, for me to consider something to be a support or resistance, A, I like to see it on a chart, and B, I like to see it on level 2. But I'll be talking about level 2 way further along in the course because it's more advanced, okay? The stronger support resistance level, the larger the implied move after the breakthrough, right? So if you have a very strong, if you see that a stock is rejected 200, 50 times or whatever, the more times it rejects a specific level, you can expect the implied move after it breaks that level to be larger, okay? So let's look at some actual examples now on the chart. So I just talked about what exactly support and resistance is. I talked about after a current resistance is broken, it now becomes a new support. And after a current support is broken, it becomes a new resistance. But now I want to actually show you on the chart so it makes more sense. So I'm a visual learner. I think it's, especially when we're talking about the stock market, when we're talking about looking at charts, it's the best way to do it. So let's go ahead and start with some examples. So let's start with support examples from high time frames. So these are going to be very high time. You can see 1 week chart. So this is Amazon. Up here at the top right here, Amazon, okay, 1W. That means each one of these candles represents a week in time. So Monday through Friday. Each one of these candles represents Monday through Friday. So I like to start with these very high time frames, whether it's the weekly or the daily, and find those macro levels to see if the stock has any major key support or resistance levels. So looking at this, you can see Amazon had a weekly support. This is not very current. I mean, it's not super old, but it's not very current, but that doesn't matter. It's just the concept that we're looking at, all right? So Amazon had a weekly support. You can see here, this candle, right? Aristotle talked about candlesticks. So this candle on the weekly time frame came down to the down tick right there. You can see it bounced off of 2250 and then closed above it. The next Monday, right? Because this candle is the start of the new week, it opened at that 2250 and then bounced off of it aggressively all the way up to close to 2400. So you can see this was a double bounce on the weekly. Now, two touches on a weekly time frame is good enough for me to consider this to be a support, especially because it's at a key psychological level of 2,250. So that's something you're also going to be you want to be looking out for when we're talking about support and resistance. So like 2,250, 2,300, 2,350, 2,400. You're going to see a lot of support and resistance levels occur at those main psychological hold numbers. So 2,400, 2,300, 2,200, and then also the increments within. So 2,250, 2,150, 2,050, 1,950. You're going to see a lot of support and resistance levels form around those whole numbers. Anyway, so this is the Amazon weekly support, and I'm also going to be showing you how I break this down. So I'll show you the daily chart also for this support, but let's look at Walmart. So here's a weekly Walmart support, and I showed this example because you're going to see how this was an old resistance. So at the end, you can see this was like at the end of 2019, Walmart came up and then started rejecting this 120, 121 level quite a bit. So it rejected it here a bunch of times. It even wicked above it, right? And tried to break through it, but was not able. It also did it here, wicked above, but was not able to actually hold above that 121 level. So this was our old resistance. Now remember what I said. When a stock breaks a current resistance, that resistance becomes new support. So when Walmart was finally able to close above 121 and break through that 121, that old resistance, right? This old resistance became new support and the stock came back down, right? It pulled back and retested that old resistance, but now it's going to be our new support. So you can see it bounced off of it multiple times. And now that 121 is our new support. It had 4 wicks down to that 121. So there you go. That is the support for Walmart. And this is that same chart, that Amazon 2250 level I was talking about, but now it's just zoomed in. So that's what I was talking about. You start from high time frames and just start zooming in to start seeing those micro levels to see where, if Amazon were to break this 2250, where could it potentially fall to, okay? And that's just what that weekly support looks like zoomed in. So again, it agrees. It came down. You can see the wick hit that 2250 and then actually closed above for the day. And then that Monday, it opened up at 2250 and bounced all the way up over 2300. All right. Daily support for Walmart. So this is, again, just a zoomed in picture of that weekly support, but you can see how many times it bounced off of that 121. So this is our floor. It was able to finally break that old resistance, and now it created a floor at that 121. Have 2 bounces right here, have a bounce right here, this big wick. It's also a pen bar, by the way, you can see, and then another bounce right here. So there you go. That 121, that was the support for Walmart. Now looking at support examples from low time frames. So you start big, and then, especially when we're talking about day trading, this is where you start coming up with these lower time frames. So 15-minute support for beyond. How do you come up with that? It's very simple. It's just looking where is the floor, where did the stock start bouncing for the day? So you can see the morning it started selling off and then had this big wick. So that represented that there was a lot of buying pressure at that 132. The next candle came down and then again wicked off of that 132 and closed up here over 134. All right. So that's a double wick right there. That represents that there was buying pressure holding up at 132 level. So if you're looking at a day trade for the next day on this day, right, then you're considering either a bounce off of that 132, or if there's a selling pressure, then it could break the 132 and continue downward. This is what 15, right? So each one of these candles represents 15 minutes of time. You can see the 1.5 at the top, all right? 15-minute support beyond. 5-minute support Visa. These are just a bunch of different examples so you can see what it actually looks like on a chart, right? So the stock came down, hit that 195, and then bounced off of it twice right here, and then came back down in the afternoon and bounced off 1, 2, 3, 4 times right there, right? So that 195 is clearly the support. That's where there are pending buyers. That's our floor for the day on Visa. 5-minute support for Walmart. Again, you can see the stock came down, hit that 120. It was like 122.9 to 123, but this was 100% our floor for the day. So it came down, bounced off, came down, bounced off, came down, bounced off, came down, bounced off. So that is our floor. This is our support because that is where there is demand. That's where there are buyers looking to prevent the price of the stock to keep dropping, all right? Now, resistance examples from high time frames. So resistance, remember, this is our ceiling. This is our volcano, right? So this is a weekly resistance for Apple. You can see it came up. Apple was on a very nice uptrend. And then it came up and hit this, it was around 328 and just rejected huge off of that. You can see this candle. This is one of those dojis that Aristotle was talking about. And then the next 2 weeks, it came up, tried to hit that 328 again, and then bounced off of it again. So there you go. That's a little double top right there. And that shows that is where that's where the sellers stepped in, right? This is the layer that created the resistance. This is where people did not want the stock to continue to go up any higher. And so the stock sold off, mostly due to Corona. You can see this was back in March, April, but then the stock came up back again, all right? And so that level, you're looking for it to reject off, or if there's enough buying pressure, can continue through. But this is what a weekly resistance looks like on Apple. So weekly resistance on JP Morgan. So this is that same concept that I was talking about. If you're looking back, this was like what, 2019, JP Morgan had a support at 105, right? The stock clearly came down, bounced off of it twice at 105, and then came back a few weeks later, and bounced off of it like 3 or 4 more times on the weekly again. So that 105 was our old support. Now, when the stock was finally able to break through that 105 due to coronavirus, that 105, that old support, is now our new resistance. So you can see exactly what happened. The stock came back up, tried to hit that 105 again. You can see with these candles, and then immediately rejected off of it like a $25, like a $25 reject, okay? So that old support became our new resistance after the stock broke through that 105, that old support. Now looking at a daily resistance for IBM. So this is a same concept, right? So the stock had this old support back at the end of 19, right? Had this old support. The stock clearly bounced off of it twice on the daily, that same 130 level. It's a double bottom, right? And then because of Corona, was finally able to break through that 130 level. So it broke through that layer of ice, it broke through the floor. And then when the stock started coming back up, right? Stocks were starting to go back up, it hit that 130. But because that old support is now new resistance, the stock came up, hit that 130, and rejected off of it about $20. Right? You can see right there. So old support, new resistance. Same thing with that JPM. This is just zoomed in, right? Very clearly on the daily chart, this is our support back in 19, because it bounced off of it so many times on the daily. So when it finally broke through that level, that 105, it came back up to retest, and that old support became new resistance and rejected off of it. Looking at low time frames. So this is a 15-minute resistance for Apple. You can see Apple in the pre-market session rejected that 324 a bunch of times. Maybe you could consider taking it on day one, but it didn't actually break through that level. But it had quite a nice buying pressure towards the end of the day. You can see here. So maybe on day two, you're thinking if it can break that 324, it can clear those sellers out from the pre-market previous day, then it could have a nice run up. But yes, we use pre-market and after hours data to come up with support and resistance levels. It's not just during the session, all right? So yellow is pre-market and after hours, the white is during the actual day. Amazon, same thing here. This is actually a double rejection. You can see at 24.80. So Amazon had a nice little run on day one. The next pre-market, it opened up, but it wasn't able to continue its run, but it rejected 24.80. It was able to get bought back up, and it rejected 2480 on day 2 pre-market as well. So that becomes a resistance because it rejected at the same price point, right? 15-minute resistance BA. Again, so the stock came up, hit that 156. Like I said, it doesn't have to hit it exactly, right? It doesn't have to hit it exactly, but it's pretty close to that 156. So it came up, rejected that 156, tried to get it again. You can see in these candles, we had some buying pressure come in, tried to hit that 156 again, but rejected off of it. Sorry. So that 156 was our resistance on BA, 15-minute. 5-minute resistance for SHOP. You can see very early in the morning, SHOP rejected 770 twice, once right on the opening candle, came up 10, 15 minutes later, tried to hit that 770 again, and rejected off of it again. Later in the afternoon, you're looking down here, 1, 2 p.m., all right? It was able to clear that 770, right? So it had enough buying pressure, and it broke 770. But then you can actually see that concept that I said. So it broke 770. The next candle, right, when it started pulling back, that old resistance, that 770 old resistance, is now new support. So this red candle right here, it pulled back, hit that 770, and bounced off of our old resistance, new support. All right. Time frames to focus on. Personally, I use the 1-hour chart to find key supply and demand levels pre-market every day, so I know where the strongest levels of the past week are. After finding these levels, I then move to the 15-minute or 5-minute charts intraday to get a more real-time view of current price action, intraday's level forming. For swing, I start by looking at weekly chart, then daily chart, then 4-hour chart. This method of working way down through the time frames allows you to see the big picture, then dial in on more important details. So how can you actually use this? How can you use support and resistance in real time? Real example of how you can use support and resistance. Now looking at this chart, sorry, I want you to tell me where the support is for Tesla, right? This is Tesla. You can see the top left. This is Tesla 5-minute chart. This is TradingView. All three of us use TradingView for charting, okay? I want you to tell me where the support is on day 1 for Tesla. 800, 802. Yeah, so a lot of you guys got it. Let me show you. Boom, there it is. So you can see 800, yes, was technically the floor, but it actually had more bounces off of 802, right? So the actual candle on this one closed at 802, and the candle opened at 802 on the second candle. And then in the afternoon, it bounced off of 802 2 more times. And then also in the after hours session, it kind of bounced off of 802. So 802 was actually the primary support level, but then 800 obviously just primarily due to the psychological level of 800. So that was our support and resistance. But how can you actually use that? How can you use, if I know that 802 is my support, I know that 800 is my support, how can I use that to trade? So I post this in the chat, Aristotle's chat. I was still planning to take the Tesla 802, 800 bounce if we get there. And what does that mean? I don't know how many of you guys are in the chat or not, but I typically trade bounces and rejects, almost every single day. And I find these levels not only using support and resistance. I'm going to show you guys how also using level 2. I'm going to show you guys using moving averages. But support and resistance is definitely a key factor, right? So I find these bounces, I look for those key levels, and you can see what happens, what happened. There you go. So on day 2, Tesla got to that 802, and you can see it bounced off of it like $10, all right? So that's how you can use support and resistance. If you know that there's a huge level of buyers incoming, then you can plan for that, and you can buy calls, or you can buy, you can long equity when it gets to that support level, right? And take the bounce off of the level, right? So that's how you can use support and resistance, and that is what support and resistance is, okay? So that's all I have for you guys today. Hope that made sense. If not, I'll be around for questions after. I'll be passing it off to Unraveler now. Thanks, guys.
Thanks, Mike. What's up, everyone? Welcome to day 2 of AMU University. Hope you guys had a great trading day today. So today's topic, before I go there, I want to make sure that you guys can see my screen, hear me just fine, and also see the laser pointer on my screen. Yes, all right, perfect. Okay, so today we have a very interesting topic. So we're going to talk about how to identify stock price trends. So can everyone see my screen? I see that one person here says that you can't see my screen. All right. So if you can't see my screen, just log off and log back in, because this is an issue some people have been facing. All right. So anyway, so today's topic is about identifying stock price trends. Okay. So you may have some experience reading stock charts and candlesticks and all of that, but you may be missing certain things. And I want to make sure that I want to fill in those blanks today. So at the end of the lesson, I want to make sure that you guys are reading stock charts differently, okay? The right way, and actually read more information that you currently do. All right, let's get started. So the table of content for today's lesson, first, I want to say what a trend is, and then we're going to learn about the different types of trends. What we're going to learn about trend lines after that. Why do we draw trend lines? How to use trend lines, selecting a time frame for trend trading, and then lastly, some trade examples. All right. All right. So let's get started. What is a trend? The general direction of movement of a stock price based on where they have been in the past is referred to as a trend, right? So take a look at this stock chart on the right-hand side, right? I think this is an Amazon stock chart before it broke the 3,000 level. So just by the looks of it, it looks like it's a longer time frame chart. You see that the low over here is around 600 and the high over here is around 2,400, right? But just by the looking at the chart, you guys can guess the direction, right? Where is the stock going? The stock is going up, right? Just by looking at it, you don't have no rocket science, no nothing. The stock is going up. This is an uptrend, right? So what is the general direction of the stock? The general direction is up. The stock is going up, right? So that's what we call as a trend. The general direction, movement of price in a chart is known as a trend, right? So how are these trends created? Trends are created based on a stock price's movements, confirming one of the main principles of TA, that is technical analysis. Prices always moves in trend, right? So contrary to popular belief, stock prices do not move in a straight line in any direction, but rather moves in a series of swing highs and swing lows. So this important concept is something that a lot of people don't get. When they learn about this concept, it becomes too late because they've already lost a lot of money. Stocks do not move in a straight line. So even though you see this in this chart, the general direction is up, right? You see that it goes up, then it pulls back, goes up, then it pulls back, right? You don't see a constant straight line. There is no linear line, right? There's always this wave-like structure between every move. It moves in waves, right? That's how stock prices move. And we call that, the technical term is swing high and low. That is what we're going to learn here now. So what is a swing high and low, right? So this is an important slide. So for anyone that's having technical difficulties, please log back in and log back off and log back in. It'll work. You are distracting everyone else in the chat right now, right? Please focus on the lesson, guys. So what is a swing high and swing low, right? when price rallies, there comes a point where it loses momentum and hits a natural resistance, right? This resistance may be the result of lack of buying in the market or increase in supply, also known as sellers, causing the stock price to pull back or decline. Take a look at this picture here, right? So this is an ideal trend, right? You don't see a straight line. You see the stocks making a push, there is a pullback, another push, there is another pullback, but eventually the stock is going up, right? So what is a swing high here? So if you just look at study the psychology of these candlesticks, you see that the stock made a push up, right? But at some point, right, there comes a point where it loses momentum and hits a natural resistance. So this is what we call as resistance. Mike just went over it, right? So at some point, you're going to hit a resistance there. There's going to be a wall that the stock hits, right? So that resistance, how is a resistance formed? That is something that, like, it's an easy concept, but it's something that it's easy to miss. How is the resistance formed? The resistance can be formed in two ways. There can be a result of lack of buying in the market. So whoever these guys were, right? So someone out there was buying. That's why the stock was going up. When demand is greater than supply, right? Stock goes up. When there is so much demand, the buyers are in control, they push stock prices up, right? At some point, whoever wanted to buy, they are no longer buying. So the buying slows down, right? So that is one point. The second point when a resistance forms is there is a lot of sellers in the market, right? After a stock makes a big move, so let's say Tesla makes a move from 620, I think today that was the move, 620 to, I don't know, 640 or something. Tomorrow there's going to be a lot of sellers sitting at 650, right? So at first point, 650 may not clear, but the second attempt they may clear it, right? Just practical examples. A lot of people are going to be sitting and waiting to take profits after a big move. It's just common sense, right? How, like, there at some point, some people are going to take profit, right? So those are the two cases of how a resistance is formed. So one is due to lack of buyers in the market, and number two is increase in number of sellers, right? So when both of those combine, or one of them or like is more than the other, right, there is going to be a wall, and that results in the formation of a resistance. And then there is a strong resistance. What's going to happen is the stock is going to pull back, right? When that pullback happens, supply is going to be greater than demand, meaning sellers are going to be in control, and they're going to be starting to push the stock price down, right? So the point of resistance where a rally ends in a trend is called a swing high. Okay, so just to recap, stock's going to go up. At some point, it's going to hit a resistance. That resistance may be a result of lack of buying in the market or increase in the number of sellers. Whatever the case is, it's going to hit that wall and it's going to start pulling back, right? The point where it hits the wall, right? This resistance, the high area, is what we call a swing high. Okay? Does everyone understand that? That's how resistance are formed, and that's why stocks pull back. They don't move in a straight line. At some point, it's just common sense. People are going to take profit. After a big move, it's not going to keep going up. They're going to take profit, right? So yeah, now we're going to learn about the other thing, swing low. What is a swing low? Swing low is the opposite of a swing high. So when price falls, right, when stocks keep falling, right, when they decline, there comes a point where it loses momentum and hits a natural support, right? Now, at some point, whoever these guys were selling, right, whoever was selling, right, at some point, they're going to run out of sellers. They don't have, everyone that wanted to sell are already out, right? And there's going to be some buyers who are interested in buying the stock too. So at some point, the sentiment is going to shift. The demand is going to be greater than the supply in these key areas. And that's what we call as the support area, right? This support may be the result of lack of sellers in the market, or there is an increase in demand causing the stock to reverse. So this is why we say that we need to watch level 2. If you keep watching level 2 in key areas, right, you know whether the stock is going to bounce or it's just going to push through. You can actually see the sentiment in the stock. You can see what the buyers and sellers are doing. The more you watch it, the more you'll be able to get a feel of the stock, right? Stock's price action. You'll learn later. Mike will teach you how to read level 2 later. But that is the kind of sense that you will have to get through experience. Okay. So this is what we call a support. So when the low point of the stock, where it hits a support and bounces, that is what we call a swing low, right? This point of support where a decline ends in a trend is called a swing low. Now, you guys can clearly see, right? This is a trend. The trend comprises of swing highs and swing lows and swing highs and swing lows and so on and so forth. So that's how stock prices move. No matter how strong the stock is, no matter how weak the stock is, it's always going to move in a series of swing highs and swing low. because that's how it works. Supply and demand is always not going to be biased in one direction for so long. At some point, the sentiment is going to shift and people are going to take profits or people are going to stop selling. Okay, does everyone understand what a swing high and swing low is? The reason I say this is because there is actually a reason for me explaining all of this. People will start trading, right? So they usually, let's say there is a resistance line here, right? Let's say there is a resistance line here, BA 200, right? BA 200 is a breakout that you're trying to play. Meaning, if BA, the stock, breaks above 200 level, right? You're going to get calls, right? So that is the logic. But what's preceding that move? BA may have been very bullish and it just after market open, it moved from 185 to 200. It made a $15 move, right? So for $15, the stock went from 185 to 200, right? Do you think after a big move like that, it is just going to break that big 200 resistance level without going through a pullback? The answer is no. That's why a lot of people get caught in false breakouts, right? So they don't see what is preceding the move. When big breakouts happen, there may be a really good level that they have, right? So Amazon 3400, 3300, whatever it is, it can be there, right? But if the move leading to the breakout, right? If it's an extended one, all the buyers, whoever wants to buy that stock, they've exhausted all their ammo, all their ammunition, they've spent all their buying power to buy and push the stock to that key resistance level. Now, all the bag holders, everyone who owns the stock, some of them at least will want to sell there and take profits. Now, if you just buy calls after a big move like that, even though the stock breaks, it's going to be a false breakout and it's going to pull back. And chances are, if you buy at the high, when IV is high and everything is high, you may be stopping out when this pulls back. Trust me, this has happened to me. How many times have you gotten into a breakout play? After you enter, you see a big pullback and you stopped out, only to watch the stock like make a return and rally higher. Show of hands, has this ever happened to you? It's happened to me. I can admit it. Like this has happened to me when I started. This always used to happen to me. I never used to pay attention to price action. I just watch the level, right? You don't see what's happening before that breakout. You don't see what's happening before that breakout. You don't see what happened, what the buyers are doing, what the sellers are doing. You just see price and you see that 200.05 and boom, oh, it broke 200. It's going to go to 210. No, it's not going to go to 210. After a move from 185 to 200, it's not going to 210. Trust me, it's not going to go, right? So that's something at the psychological standpoint, you have to understand that, right? Always, if you see a big extended move and you see that the swing high is formed, there is no swing low forming, wait for the swing low to form. And a smart trader would either buy the dip here or they would wait for the re-entry. So what the re-entry means is, let's say this is 200. There was a rejection here. The second time it breaks 200, you enter the trade. Okay. So that's how you need to think about from a trading standpoint. You learn the concept of swing high and low. From a practical standpoint, this is how you need to look at swing highs and lows. Okay. So what are the different types of trends, right? So now that we know that all trends are made up of swing highs and lows, we know how to read that trend. What are the different types of trends? The ability to identify a trend is crucial when it comes to trading. You probably have heard of the saying, the trend is your friend. As a trader, you should know how to identify price trends and so that you can trade with the trend and not against it. So last couple of days, even today morning, right? The trend is all bearish, right? Everything was bearish. Everything was trading below all key supply level. So at that point in time, if you're trying to trade breakouts, right? You're going to get stopped out because chances are it's going to break that level and then reject off of that because a lot of sellers are waiting there, right? So that's a common thing. Well, whatever the overall trend of the market is, you need to play in that direction, or else you need to choose a stock that's trending well, right? So that is why there is a saying that the trend is your friend. Because if you trade against the trend, even though you are a great trader and entry and exits are perfect, right? Your chances of profit are very slim, and you're going to be making it very difficult by getting into a trade that is against trend, right? So always remember, trend is your friend. Okay. Now, what are the different types of trends? So there are 3 different types of price trends. 1 is the uptrend, 2 is the downtrend, and 3 is the sideways trend. Now, all 3 trends are important. Now, let's take a look at each one of them. All right. So uptrend. Just give me 1 second, guys. Let me get some water. All right. So what is an uptrend? An uptrend is a bullish move where the stock price gradually rises over a period. An ideal uptrend is characterized by a series of higher swing highs and higher swing lows. So you guys can see that uptrend. It's as the name implies. It just means that the stock price is going up over a period of time, right? It is called an uptrend because every swing high that's formed is called every swing high that is formed is higher than the previous swing high. So you guys can see that here is swing high number 1, swing high number 2, and this is swing high number 3, right? So in an uptrend, what's going to happen is every swing high that's formed, the height, right, is going to be higher than the previous swing high. If you compare these two, you can see that this is the peak of this is higher than this one, right? And similarly for swing low as well, the swing low that's formed here is higher than the previous swing low, right? So there is a reason for that. So if you read my post on Instagram or anything, I used to say that I stopped out of a trade because I bought the uptrend, but I saw the stock breaking trend. I saw the stock making higher, instead of making higher lows, it broke trend, right? That is an easy way to get out of a trade. So if you see the stock breaking the low over here, right, that means that the stock just broke the higher high and it's no longer an uptrend, even if it's an intraday basis, right? So that is one of the ways you can use to stop out of trades. So it's very important to know that if you're on an uptrend, that you keep an eye on the all the swing highs and lows, because you want to make sure that the uptrend is still intact, right? No matter what time frame it is, right? So that is an uptrend here. Now let's look at a downtrend. A downtrend is a bearish move where stock price gradually declines over a period, right? So it's the same concept, downtrend, as the name implies, the stock price moves down over a period of time, right? And same concept, there is swing high here, another swing high here, and every swing high that's formed is lower than the previous swing high. So this swing high 2, it is lower than the previous swing high. And that's why it's called as lower swing high, right? And every swing low here that's formed is lower than the previous swing low, and that's why we call it as lower swing low, right? And at some point in time, in a downtrend, if you're looking to buy a reversal trade, right, you want to make sure that first of all the stock stops making a new swing low and that it makes a higher high. So what do you mean by higher high? So you want to see something like this. So at the end of a downtrend, you want to see something like this happen. You want to see a higher high, you want to see a higher low, and then you want to see the stock breaking the higher high, right? That's when you know that the trend is broken, right? So this is something that you need to keep an eye on, and we'll look at stock charts later, but this is another important concept. For swing highs, you want to make sure that every swing high is formed as higher than the previous swing high and low is formed above the previous swing low. And the opposite is true for downtrends as well, right? So does everyone understand what an uptrend and a downtrend is? Basically, stock moves up over a period of time, that's uptrend. The stock moves down over a period of time, that's a downtrend. All right. And swing highs and swing lows is a very, very important concept, and you have to absolutely learn how to identify them so that whenever you look at a stock chart, the first thing you see is, hey, the stock is making a considerable move. I'm going to wait for the pullback before entering the trade, right? That should be second nature to you. You shouldn't be chasing like a novice trader. So after AMU, I want you guys to think like professionals, right? You guys need to think like a pro. So if you see a big move like that, don't chase. You don't have to chase. The market's not going to go anywhere, right? There's always going to be another move. You just wait for that pullback. After a $15 move, obviously this is going to pull back no matter what. And you're going to wait for the pullback. And once sellers lose control and buyers take over, that's when you get in, right? So you got to learn how to identify these swing highs and lows and learn how to properly read the chart. And that's going to take some effort, but I want to make sure that starts again. That process starts today. Okay. All right. This is the most important slide. Sideways trend. So forget, even though you don't understand the uptrend and downtrend, those are easy concepts. It's easier to grasp. Sideways trend is most important in my opinion, right? So what is the sideways trend? A sideways trend is a period where stocks trade in range without making any new highs or lows, right? You guys can see that there is a swing high and low forming here, but then from May 14th until June end, right? The stock is not going anywhere. There's no new highs or lows formed. It's just chopping around, trading in sideways, range bound. There are like 100 different ways to say the same thing, right? It's just going nowhere. It's just trading sideways, right? So a sideways trend is a period where stocks trade in range without making any new highs or lows. And stocks trade sideways when there is indecisiveness in the market, usually after a big impulse move or at the end of a trend, right? So in this case, the stock made a move from 38 to 41 from April to May. So for 1 month, the stock was in a constant uptrend, right? And at some point, hey, before breaking this key level of resistance, there is going to be some consolidation. What is consolidation? That is a big question, right? Consolidation is nothing but think of it like a boxing match between bulls and bears, right? They're going to fight for control. Whoever wins that battle, right? The stock is going to break in that direction. If bulls win the battle, buyers outweigh the sellers, then once the accumulation is done, they're going to break the stock is going to break to the upside. If there are more sellers than buyers, at some point, no one is going to be there left to buy the stock, and they're going to break to the downside. Okay. All right. Now, as a trader, it is very important to avoid participating in the market when it is trading sideways. This is a very, very important point. So, especially, I think Mike mentioned this in the last class. When a new trader starts, right, they have that 9 to 5 mentality. They think that they need to trade the whole day. They need to put in the most effort, and that's when they make the most money, right? That is actually a false belief. You only want to stay in the markets or in a trade or want to trade when conditions are favorable. That's how a pro thinks, right? You don't go chasing trades. You have to wait for the opportunity to come to you. And if there's a good opportunity, you have to absolutely capitalize on it. And if you see the market or a stock trading in range, offering no entry or exits, right? You absolutely should not enter that trade, right? As a trader, it's very important to avoid participating in the market when it is trading sideways. You should know your own value and value of your own capital. Absolutely avoid participating in a stock if it's trading like this, right? So Tesla has been like trading very, very choppy this last week. And today it actually looked very weak, but then I got caught in one trade. I took a loss. I think a lot of people took loss in Tesla. Everyone that I follow took a loss on Tesla. I think it's the same $700 put option. So I'm kind of like, okay, everyone got trapped. So I'm okay. All right. Anyway, so yeah, so it's very important to not participate in the market when it is trading sideways, right? As a trader, what you can do is I can wait for market to break out of this consolidation range before entering, or select a stock that is showing a clear trend. Now, if you see Tesla's behaving choppily, right? You don't have to trade Tesla. You can trade SQ or Roku or something else, right? That's showing clear trend, right? That is a decision that you can make. Or if everything is shopping around, right? You can just choose to trade something else or wait for the perfect opportunity when the stock breaks out of this range, right? So those are the important things. And trust me, this is actually in a statistics. 70% of the time throughout the year, stocks trade in ranges. Right? Stocks going to be consolidating in some range. It's going to be a $10 range or a $15 range. It's not always going to be like breaking out, right? It's not going to be uptrending or downtrending. 70% of the time of the period throughout the year, a stock is going to be spending time in its range. Imagine, think about Amazon. How long was Amazon in that range, like on $150 range, right? Crazy. Amazon was still in that range. It looks like it still looks very big. It just wants to push past that 3,500, but it just can't, right? So stocks spend more time in ranges, and it's your job as a trader to identify when a stock is trading in range and avoid participating in that stock. Okay. Anyway, does everyone understand what sideways trend is? So far we've seen uptrend, downtrends, and sideways trends. Those are the three different types. There are no more, no less, just three types. Okay. All right. So this is an example that I want to show you guys. This is what we call as looking at the bigger picture, but as this is what we call as being aware of the bigger picture, but also taking into consideration what is happening in the smaller time frame. So take a look at this chart. So the general direction of this chart is up, right? Now, if I open the weekly time frame or even the daily time frame, right, this is what you're going to see. You're going to see a bunch of green candles, something like this. You're going to see something like this, right? You're going to see something that's constantly going up. There may be a small noise this year, like small pullbacks and everything. But generally, this stock that I'm showing you here is just going up, right? Now, if I switch to a more intraday time frame, like let's say 4 hour, 1 hour, or even a day, even let's say 15-minute or something like that, right? You're going to see a different picture. You're going to see small uptrends. You're going to see small downtrends. You're going to see sideways trends, periods of consolidation. And then you're going to see uptrends, a downtrend, right? Now, as a day trader, especially as a day trader and as a swing trader, right? You want to know, you want to study what's happening in the smaller time frame more than what's happening in the bigger time frame. So Amazon, it's been in an uptrend since, I don't know, 5 years, right? What's the point? So you can't just say that I'm going to be trading Amazon because it's up when it's clearly in a downtrend the last 2 weeks, right? You guys get the point, right? You always need to consider what's happening in the short term as a day trader and as a swing trader, because that's very important. You can't go trading against the trend when the stock's selling off, right? So that's very, very important. So that's why I wanted to show you guys this. Even though you know that the overall trend is up, you have to pay attention to the smaller time frame. That's what we're going to learn today, multi-time frame analysis. Okay, does everyone understand this? There's nothing, it's pretty straightforward, right? All right. So now we're going to learn about trend lines, and after we learn about trend lines, we're going to learn about multi-time frame analysis and then go over some examples. Okay, so that's going to be the fun part. Let's learn about trend lines. So trend lines are lines drawn on a chart connecting the swing highs and swing lows in a trending market. It is used by traders and technical analysts for trend identification and confirmation for trade entries and exits. So you guys can see that this is a typical higher high, higher low, right? This is an uptrend. This is a downtrend. Trend line is nothing but a line drawn on a chart. If you have TradingView, there is an option over there in the left-hand corner, which I will show you now pretty soon. You just have to click that button and you're going to get a drawing tool. You just have to connect lines on the chart and you'll get a trend line, right? So trend line is just a visual representation of a trend, and that's going to help you form your basis for entries and exits, right? So how do you draw a trend line? First point, you have to identify swing highs and swing lows in a trending chart. So you know how to identify swing highs and lows, right? A decline ends, that's called a swing low. A rally ends, that's a swing high. Decline ends, swing low. Rally ends, swing high. And then swing high again, swing low again, right? So once you identify the swing low, all you have to do is draw a line across the chart, and that forms your trend line, right? An uptrend line is drawn by connecting at least 2 or more swing low points. So the prerequisite condition here is that you need to identify at least 2 points before drawing a trend line. You need at least 2 points before you draw a trend line. If you just have 1 point, you can't just simply draw it out of thin air, right? You need at least 2 points. The downtrend line is drawn by connecting at least 2 or more swing high points. I think I got cyber COVID from Mike. All right. A downtrend line is drawn by connecting at least 2 or more swing high points, right? So same concept. In a downtrend, all you have to do is identify a swing high, right? 2 points. Once you've identified that, just draw a line across the chart, and that creates your uptrend line. Sorry, a downtrend line, right? So now pay attention. The most important point is this point here. To draw a trend line, all you need is 2 points, right? If you have 2 swing low points, boom, you can draw an uptrend line. If you have a swing, if you identify 2 swing high points, you can draw a downtrend line. But the most important point is a trend line becomes active when the price makes contact at the third touch on the trend line. If the price breaks the trend line on the third touch, then that trend line becomes invalid. This is the most important point here, guys. So you can draw a trend line with 2 points. Now, let's say the stock over here, right? It's not made its third touch here. If the stock tests this trend line and bounces off it, then you have a valid trend line that is actually very strong. That's a strong trend line. The trend line becomes active on the third touch. Okay, that's a very important point, because that shows that people in the market, like a lot of people, hundreds and thousands of people, have also drawn the same trend line. They also have the same trend line, algorithms, everyone, right? They have the same trend line, and they're also waiting with buy orders over here at this point to push the stock prices higher, right? So these trend lines, technical analysis, everything, right? It only works because a lot of people are also following the same thing. Hundreds and thousands of people are doing technical analysis. They have the same BA200 level. They have the same 650 level on Tesla tomorrow. Everyone's watching that 650 level on Tesla tomorrow, right? So if a lot of people are watching the same thing and price action is strong, you're going to get a bounce. If not a lot of people are watching, the price is just going to push through, right? If your trend line is not a valid one, it's just going to push through. It's not going to bounce, right? If the price does not, if price breaks the trend line on the third touch, then the trend line becomes invalid, right? Okay. So important, another question that I get, I mean, all batches, they ask me this question. The trend line is drawn in an area where you can find the most touches. It doesn't matter if it is the wick or the body of the candle that you connect, right? So you guys can see, you know what the wick of the candle is, right? It's this line here, right? It's this tail wick here. It doesn't matter if you connect if you draw the trend line on the wick or the body of the candle. It's just an area where you can find the most touches, right? That's how I draw my trend line. All these trend lines and points is just diagram. It's not an exact number. It's just an area. It's okay to be a few cents off. Okay, or you have to find the most touches, find the most common area that you can connect. Right? Does everyone understand how to draw a trend line? All right, perfect. All right. So now we're gonna talk about why we draw trend lines. So what's the point? How is it useful? Right? Trend lines act as a form of support or resistance and help traders plan their entries and exits ahead of time. I saw some question, someone asked a question when Mike was going over support and resistance. Can trend lines be horizontal, like vertical, diagonals or something like that, right? Yeah, so that's what we call as trend lines. Trend lines can act as a form of support or resistance. Like they don't have to be horizontal lines. They actually form the price trend, right? They act as borders for the price trend, and they act as a key form of support or resistance line. And if you are actually looking to trade a break of a trend, right? I told you, right? At the end of a downtrend, sometimes the trend breaks, but these can also be called as channels. These upper channel and lower channel act as support or resistance. Easily help you form trade entries and exits, right? That's very important. You can't always keep waiting for one big key level. Sometimes you have to enter a trade where there is good price action, and these areas usually you have good price action. Second is, break of a trend line is a sign for potential reversal in the stock. Traders can capitalize on break of trends to either exit their current position and or take a new position. It can be either long or short based on the direction of the new trend. So this is a downtrend, right? You have 3 touches. 1 touch, 2 touch, 3 touches. This is a solid active trend line, right? So what's going to happen is when price retraces to this trend line point, right? This is a very key resistance. Now you are hoping that the stock reverses off of this trend line. But if there is good bullish price action and the stock breaks this trend line, then that is considered as a reversal, right? The stock broke this trend line, I told you, right? It is no longer forming a lower high and lower low. It broke the trend and has now surpassed the previous swing high, right? So now what's going to happen is it's going to pull back, form a lower low, and then going to take off, right? That is how we need. So you don't have to chase here. Remember what I told you. If you see a big move like this, wait for the swing low. It's probably going to retest this trend line. So if you draw a horizontal support line here, right? A resistance or support line here, right? Stock is going to retrace, touch that level and bounce, like boom, right? That's what's going to happen here. Same concept, 3 touches, uptrend line. At some point, uptrend, no trend is going to last forever. No trend is going to last forever, and at some point, a trend is going to break. And when the trend breaks, you can capitalize on that break and trade the reversal. So Alyssa asked me a question. So after 3 touches, is it bound to break out? No, not necessarily. So if you're trading in a longer time frame, right? Let's just assume that you're trading on a daily or 4-hour time frame. That's a good question. So if you're trading on a longer time frame and you see a lot of touches, not just 3, you see like 10 touches, right? So if you see a stock touching so many times of a key level, 9 times out of 10, if you don't have strong price action, that level is going to be treated like a rejection level. So let's assume that there is a very, very key level on Tesla, 650 tomorrow, right? Let's say the market is selling off like crazy. Market opens, but it's very choppy and the sentiment is shifted bearish, right? So the Tesla may approach 650, but chances of a breakout are very slim because the overall market is also selling off. And unless Tesla has a very good catalyst, that level, despite it being a key level, it has more than 3 or 4 touches, right? It's not going to break, right? The same concept applies to a trend line as well. If the sentiment is strong around this trend line, and then the break, no matter how many touches it is, it can push through. But if the sentiment is still weak, then the trend line is still strong, it's going to act as a resistance. Okay? which time frame is best for detecting a trend line. We'll go over time frame soon. All right, so those are the two reasons why we draw trend lines. So one is one, we know that is going to act as support or resistance. And the second reason is break over trend line gives us an opportunity to trade the reversal. Okay, so those are the two use cases for drawing a trend line. All right. Yes, Christopher, you can use that. All right, so now we're going to talk about time frame, right? So Quinton asked me a question, which time frame can we use? How do we actually use this for trading? That's what we're going to learn now. So how do you use trend lines and select a time frame for trading? Trend lines can be placed on any time frame, but they are generally more effective on longer time frame, right? So you can draw a trend line even on the 5-minute chart, 10-minute chart, 15-minute chart, but they're going to be more powerful on longer time frames. It's just a given, because the longer term picture, we just saw that, right? The long term picture is up. So the same concept will apply for trend lines as well. If you draw something for the long term, it's going to respect that trend line more often than not. But smaller time frame, a lot of noise. There can be a lot of noise during intraday and smaller time frames. So you see a lot of reversal shifts and everything. So that is something that you just have to be aware of. Trend lines can be placed on any time frame, but they're generally more effective on longer time frames. A short-term trend can last anywhere between a few hours to several days, and the intermediate-term trend can last between 10 days to a few months, and a long-term trend can last anywhere between several months to several years, right? And if it's a really good company like Apple or Amazon or one of the big ones, right, they're going to have a constant uptrend, especially if you go back to last 5 years, right? You'll see the stock is on a constant uptrend, right? So that's what you're going to see. But if you're going to look for a day trading time frame, right? So good example I can give you was Tesla, right? Tesla was trading 900s, then it started a big downtrend from 900 to, I think stock bounced at 529, I believe 521 or 529. That was the low, and then it bounced again, broke 717 was the high for Tesla, then rejected again, came back down to 580, and then Cathy Wood bought more shares. They took it back up again, and then now it's again coming back up to 650 to see if it can break after last week's rejection. So you guys can see that there is a lot of back and forth happening, right, in the short-term time frame. So that's what we call as an intermediate and short-term time frame trend. And if you're a trader, you need to be paying attention, because those trend lines, you can actually draw trend lines on those as well, are going to be only respected on a short-term time period. It's not going to be respected for a long period of time. It may last a few hours or several days, but at some point in time, everything is going to form a base and then it's going to reverse, right? Anyway, so let's look at the process of what it is that you need to be looking for. So step one, as a day and swing trader, I'm interested in short and intermediate term trends. So I start with the daily time frame and work my way down. Identify the swing highs and swing lows of a dominant trend and draw a trend line. So you can start with the daily time frame, which is what I usually do. I draw my trend lines. Oh my God. All right. So I identify the swing highs and lows of the daily time frame, and I draw a trend line there, right? So once I know what the dominant trend is, then I jump to the smaller and short-term time frame trends. So I'll use the 4-hour or 1-hour chart to analyze, draw, and trade the short-term time frame in an intraday basis. Okay, so 2 steps. Start with the daily time frame. Look at the big picture. No matter what stock you're trading, look at the big picture, see what's happening, because you'll know what the overall sentiment is just by looking at the daily time frame or even the weekly time frame. Daily is more than sufficient, but after you're done analyzing that, come to a smaller time frame, because that's what you're going to use for trading. 4-hour to 1-hour chart, and you will get a lot more data. You'll get a lot more candlesticks once you shift to a smaller time frame. You can draw your same trend lines in those time frames, right? After identify swing lows and highs, draw the trend lines. Important note here, smaller time frames usually contain a lot of noise leading to fake outs. So even if you prefer to execute your trades on a smaller time frame, it is always better to check the longer time frames for confirmation. So if you're drawing a trend line on 15 minutes or 5-minute charts, I draw it all the time during the day. I draw all those flags and pennants and symmetrical triangles and whatnot during the day, trying to identify some kind of key level where momentum is going to be, right? So I do all of that, but know that they are very, very, very weak trend lines. because hundreds and thousands of people are going to be watching longer term trend lines, but not so many people are going to be watching short term trend lines. So they can easily be a lot of fake outs happening. So if you see a trend line break like that, right, in an intraday basis, always look for confirmation with something else, because 9 times out of 10 that can be a fake out as well. And that's one of the cons of using trend lines in a very small time frame. Okay. Step number 2 is find areas of confluence for entries and exits. So I think we've come to the main part of today's lesson. So even though you know how to draw a trend line, right, that is not enough in itself for getting in and out of trades. You need to be able to find an area of confluence for entries and exits. That's what I say here. Don't enter a trade based on prediction. That is, because you think price will react in a certain way at a trend line. Price can always break or reject the trend line. So you should always enter a trade based on price action at areas of confluence. So I'm going to explain to you what I just said. So let's assume that this is an uptrend, right? You draw an uptrend line. Okay. Wendy, I'm going to answer that question. 1 second. All right. So we have an uptrend line here. We have 3 touches. So you get the confirmation that this is a solid uptrend line. You can enter the trade on the 4th touch. You're convinced. You're so biased. You're convinced, right? So the stock actually bounces on 3rd touch, and the 4th touch it's coming. Before it tests, you're already trying to get in the trade, right? You're already predicting that this is going to bounce at this trend line, and you're getting on this trade here without confirmation on anything else, right? So what's going to happen when you make a gamble like that, right? Sometimes you may get lucky, but sometimes price just pushes through, forcing you to stop out, right? So you can't just base an entry on the touch of a trend line alone. You also need to rely on something that we call as areas of confluence. So what is an area of confluence? An area of confluence is the intersection of key levels in a chart. It can be an intersection of a trend line, key level of support or resistance. It can be a moving average. It can be a Fibonacci retracement level, which is something that I will teach you in lesson number 10. But you guys get the point, right? So if you rely on 1 point for confirmation, just the trend line, that is a good setup. But if you base your entry on the intersection of a key level like a trend line with the support level, and there is also a moving average there, so it's just going to increase your probability of success, right? So let's say the same thing, right? So instead of entering here, right, let's say what you're going to do is there is a support line here. You draw a support line here. You're, instead of waiting for the trend line, you're actually waiting for the bounce here, and then you can trade it. Right? I'm just giving an example. So that is an area of confluence. An area of confluence is an area in the chart where you have multiple key levels intersecting. So it can be a trend line, support resistance level, moving average, Fibonacci level, or whatever, right? Does everyone understand that? It's instead of just relying on one thing, you're relying on multiple variables. So trading is a game of probability, right? So the more things that can give you confirmation, the better your odds, the higher the odds of success. That is always what we're looking for. We're always looking for high probability, right? We're not gamblers here. We're just looking for more information. The more variables give you the green signal, you get in. If nothing is not giving you the good signal, you're not getting in the trade. How many confluences do you need to look in order to enter? I'd say 2 is enough. 2 is enough. Especially, it depends on the type of confluence it is. If you see a long-term trend line supported by a big macro level, that is more than enough for you to get into a trade, right? Yeah. So I'll show you guys what a confluence is when I go over the chart. But I just wanted to tell you guys that area of confluence is just an area in the chart where multiple variables intersect. The variable can be a trend line, it can be a support or resistance level, or it can be a moving average. All right. So once you identify an area of confluence, you establish your entry and exit points and stop loss level based upon that. Should we use the media as a tool to help us with confirmation? I don't understand the question. All right. Anyway, so summary. News. Oh, yeah, you can use news is not an area of news is just a catalyst. So if some news drops, right, it's going to create price action. It's going to influence buyers and sellers to some extent, but it is not going to influence any technical level. So the news is not going to say that, hey, watch that 650 on Tesla. News is not going to say that, right? Price action is going to dictate that. People are going to react to that level And that's what's going to make it work. Okay. News can create bias, but news is not going to determine your technical entry and exit, right? Anyway, so summary, trade entry always needs to be based on price action at areas of confluence, always, right? You cannot be too biased. It always needs to be based on the areas of confluence. Area of confluence is only relative to reading the chart. Yes. Check if there is good volume at this area of confluence. So this is another important indicator. So I think tomorrow we'll go over volume and momentum tomorrow. So volume essentially refers to the total number of buyers and sellers, right? So if you see the transaction, let's say for volume for the first 1 hour of the day is 1 million, right? So 1 million shares have been exchanged for that period, right? So you at key levels, right? When I say that area of confluence, you see the moving average and you see a trend line and a support level intersect, right? Price action should be extreme at those levels. There should be price action expansion. What do I mean by that? So there is going to be hundreds and thousands of orders sitting at a key area with buy options. So let's say that a lot of people they see that Tesla might consider 800, right? I'm going to use the same one. 800 level on Tesla. The stocks falling, hundreds and thousands of people are sitting with orders at that key area of confluence, right? 800 is a key level. Everyone wants to buy that. They're all putting their orders, buy orders, and waiting to get filled, right? So when that happens, right, you see a huge volume bar popping because a lot of people are trying to hold that stock and try to push it up, right? So that's why the stock works, because key area of confluence is where a lot of key level intersect. And that's where trading activity is going to be extreme. A lot of people are going to be interested, and that creates good volume. So if you're looking to enter a trade on a bounce or anything, that's why we always say that you need volume confirmation. If there is no volume, there is no trade, right? It's the same on anything. It can be a stock, it can be an option, it can be anything, right? Whatever it is, you need volume, or else it's whatever demand is created, it's just artificial. All right. So right. Check if there's good volume at this area of confluence. Trading activity should expand at the areas of confluence. And then use multiple time frames to confirm your directional bias. Long time frame trends are stronger than short time frame trends, and sentiment will be stronger. Relying on multiple confirmation increases the probability of the setup and helps reduce fakeouts. Hence, the importance of areas of confluence, right? So now we're going to look at some examples, some real examples, real trades that we did. So first trade here is Peloton. So Peloton, you guys, I will show you the real chart, but this is something that I posted in the chat. So you guys can see that I've drawn a channel right for Peloton. So Peloton was being respected in this channel. We're just trading in this channel, and my rationale was break below 33.25 for puts. If the stock breaks the 33.25 level, I will trade it to the downside and buy puts. And alternatively, if it breaks above 34.6, I'm going to get calls. So I said that Peloton has earnings after hours, and I'll play puts if I'm playing. Okay, so that's what I said. And let's go look at the trade now. Actually, you guys can take a screenshot of this, but I'm going to open my trading view and actually show it, walk through there. Okay, I'll give you 5 seconds to take a screenshot because this is actually a nice picture. Okay. All right, so that's trade number 1. Trade number 2 is again Peloton. This is a solid uptrend bounce on Peloton. We actually got a very, very nice move on Peloton on this, like more than $20 move on Peloton in just a span of 2 days. Right, it was a clean uptrend bounce. As also we took. Right, so I'm going to jump to my trading view now. All right, can you guys see my trading view? Yes. All right. So this is the Peloton chart. I use the dark theme so that it's clearly visible for you guys. Can you guys see this chart fine, just fine, or do you want me to zoom in more? It's fine. All right. Okay. So currently I'm in the daily time frame, and I'm just going to walk through this chart, right? All right. Someone asked me to zoom in, so that's usually a request I get. I will do it. All right. So I'm 125% zoomed in right now. So I'm just going to walk through this chart. So Peloton IPO'd September of 2019, right? So I don't have a lot of data to go by. So I just waited for the stock to form a base. So this was the base, IPO base. The high was 28 and the low was here 21. So it had a $7 base. It formed a base and eventually it broke. The stock was in a downtrend and it eventually broke the downtrend over here and started an uptrend here. So ever since it started an uptrend, right? Higher high, higher low, higher high, higher low, higher high, higher low, right? So I was able to easily draw an uptrend line. So I'm going to teach you guys a trick. If you're not used to drawing candlestick charts yet, so you guys can see my mouse, right? So on the top corner, there is an option here on trading. You can actually switch to the line chart and you can actually see the line, right? So you can see that this is a downtrend line and the lower low was broken here and the stock started creating higher highs after that. You guys can see that this is a clear uptrend, very strong uptrend, right? You guys can clearly see, read price action a lot more clearer if you are not yet used to reading candlestick chart. But I would really recommend you to start learning because you're going to be real traders, right? So first things first, I drew a trend line here. So I'm going to remove this for now. So you guys can see that I have to click this button here. There is an option called as trend line. Once I click that, I can easily just click at one point and draw a trend line. All right, this is not the right nice color. So I'm going to change it to yellow. I'm going to change it to a line here like that and I'll draw it. Okay. An area where you can find the most touches. So you got 1 touch, 2 touch, 3 touches, 4 touches, 5, 6 touches, right? So anyway, all right. So this is an uptrend line and you can draw the uptrend line on the upper channel as well. So usually I don't just draw the down channel. I like to draw the up channel as well. So all you have to do is connect all the swing highs here. So we have 1, 2, 3, 4, 5 swing highs here, right? So this is what we call as a channel, an uptrend and a downtrend, an uptrend channel, right? So at some point, right, you guys can see that the stock created a higher high here, higher low here, and another higher high. It wanted to create a higher low here. It tried to bounce. It did bounce, but the next candle it broke, right? So the stock failed to create a higher high. It almost dropped to the previous swing low and then tried to create a high, got rejected off of this trend line resistance here, and then started a downtrend. So if I turn this chart to a line chart, swing high, lower swing high, lower swing low, lower swing high, lower swing low, lower swing high, lower swing low. See what happens? See how the sentiment just shifted on this chart, right? It was an uptrend, but momentum was killed over here, right? In this point, the momentum was killed. The stock failed to create a higher high. Sellers took control. Once the trend line broke and the stock tried to reclaim it, it rejected. That's when you know that the stock is just creating a lower high, just started a new downtrend. Okay, so you guys can clearly see, right? These are concepts that you learned today. You learned that stocks move in series of swing highs and lows. At some point, if you see the stock failing to create another swing high after pulling back, so the stock pulled back to create a new swing low, right? But over here, it couldn't reclaim it and then it started to reverse again, right? So can we tell the reversal based on volume? No, you can't just tell a reversal based on volume, right? So volume is only going to increase or decrease in key levels. So at some point, when there is a trend line break at that area of confluence, you will see high volume. But you cannot tell that reversal is entirely based on the volume, right? Even when the stock bounces, you're going to see high volume, not only when the trend line breaks. Volume is just indicating that price action is strong, right? The price action is going to tell you whether it's a reversal or a bounce. Okay, I hope that answered your question, Jordan. Okay, so we started a downtrend here. So we started a downtrend and you guys can see that I just connected a downtrend line here. So all I did was use this trend line, kind of connected all the swing highs. So 1, 2, 3, 4, 5, right? And at some point, this downtrend again was broken at this level here, right? This downtrend line was broken, right? So from December 20th until February 4th, February 5, which is when I signaled this trade, right? So it's a span of 2 months. Peloton was trading in this range, this channel, right? Kendall, I'm going to answer the question. When are you going to enter the trade? I'm going to answer. I'm just walking through this chart so that I'm trying to teach you guys how to draw this trend line and how to create these trend lines, right? We'll get to the trade in a moment. So once you try to understand, once you try to create these trend lines, right? So this is telling you the whole picture. This channel created the entire uptrend channel. This is a downtrend channel. Now we have a weak, kind of a weak, you can even call it a kind of a bear flag. But this is a small uptrend channel here. The stock has been trading in this range from December to February. Okay, so I'm going to shift to the 4-hour time frame so that I can show you guys with more data. Okay, so I'm now in the 4-hour time frame. So you guys can see that I get more data to play with now, so I can read more price action a lot more clearer. Okay, so my idea here was Peloton was going to report earnings on February 6th. Okay, February 5th night, I posted a trade saying that, hey, Peloton is going to test the upper end of this trend line, right? The sentiment around this stock is actually kind of bearish. Okay, so leading into earnings, they may sell off. So the sentiment may be a little bit bearish. So that's why I told them that if the stock rejected off of this trend line, I want to get into puts. So how I got the entry point 33.25, I'm going to tell you now. So throughout this chart, I'm surprised no one asked me this question yet. There are a bunch of green lines over here that I've drawn, right? You guys have noticed right now. So those are actually levels of support and resistance in my chart. And if you guys notice the 33.25 level, so let's go back in time, right? So this 33.25 was initially a resistance. You guys can see this candle wicking, right? So this was a resistance line where the stock rejected initially, and then it broke out. So this resistance became support. And then you guys can see the strong wick again. So it was a strong level. The stock bounced here again. Then this resistance line turned support. It broke the support again, so it became resistance, got rejected again, bounced, rejected again 2 times, 3 times, 4 times, 5 times, 6 times, 7 times, 8 times. You guys can see this, right? Does everyone see what I'm doing here? I just go back in time and I'm just visually seeing where the stock has strong price action, right? Just going back in time, and I'm not doing anything rockets. I'm just spending some time doing some data analysis. I'm just doing some data analysis, going back in time and seeing where price action was strong. Where are the buyers and sellers interested in this stock? And you guys notice one thing, whenever this level broke, look at the volume, this high volume break, 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 right? This is not made up stuff. This is what happens. So my trade idea is, if the stock retests this trend line, the higher and this red line here, and it gets rejected, and it also breaks this 33.25 line, this green line, I'm going to buy puts. So that's multiple confirmation, in my opinion. It rejects off the trend line, and it also broke the key support level, right? So those trend lines you can only draw on 4-hour. No, not necessarily. So I was initially in the daily time frame, right? Same trend line, you can draw it here. It's just that you won't see that much data. You don't see too much data when you're, so you just see one big candle. It's hard to trade this candle, right? So if I jump to the 1 hour, it'll actually be even more clearer if the data loads. All right, here it is. Okay. So you guys can see what's happening, right? So once I see the stock breaking below this level, I enter the trade. So you guys can clearly see, right? There was a bounce first, and then it tried to reclaim. It really couldn't. It broke support, and then it dropped to 31.9, which was my profit target. If you actually go back to that screenshot, my PowerPoint, 31.96 was my profit target, because again, this is also another key level in the chart. If you go back in time, you can see that 31.9, 32 level was a very, very strong level of support, right? The stock bounced off of this, but then what happened after earnings is they actually sold off after earnings, and you can see the stock breaking this 3 or 4 month long or 2 month long trend after earnings report, and then they started a new downtrend. Okay, so this is how you should actually identify stocks. Every stock chart actually has a story behind it, right? I always tell this to everyone, every new trader I see. Every candlestick tells you a story. Every stock chart has its own story. You just have to spend some time to analyze this trend and try to make sense of the price action, right? So this is something that you have to actually sit and do and understand. Okay. So now after this break of trend, you started a new downtrend. That's when I draw this trend line. You guys can see that this is a descending trend line. First, it actually broke this trend line and it actually broke the IPO low. The IPO low is actually very, very strong support. It broke this level, again, another area of confluence. We broke the trend line. That is one confirmation. The second confirmation is breaking the IPO low, which is a key support. We broke that. And after breaking the IPO low from 20.5, the stock actually had a big drop to 17.5. Okay. So this is, again, someone asked me what area of confluence is, right? I showed you two now. 1, 2, right? But after at some point, we bounced off of this and you guys can see this bullish engulfing candle, right? Bullish engulfing candle, and we started creating higher highs and the stock made an uptrend. We had a small sideways price action here, but the stock broke above the sideways price action, started creating higher highs. And then we created this uptrend. So this is the second trade that I signaled in the chat. So we started a very, very bullish uptrend on Peloton because of COVID from May 27. You guys can see that once this level was broken, Peloton was in a very aggressive uptrend. So from being a $30 stock, it actually rallied to 170, right? So this is another uptrend. And this is an area where I actually signal the chart. This is an area of confluence. The 64, the 66 level here, this line here, right? So I don't know if you guys can see this. Let me change the color. All right. So you guys can see this, right? So Peloton was an aggressive uptrend, but we also had this macro support line was forming. So we had 1, 2, 3, and the fourth touch is this area of confluence of 64.8 or 65. And that's also coincided. That's where also where the trend line was coinciding. And this is where we bought the dip for entry. And ever since, it's been a very, very aggressive uptrend. Sorry for all the lines. There's too much. I love Peloton, the stock. So I've been trading it from IPO. You guys can see this very aggressive uptrend. So if you manage to catch this move, like even by luck, right, couldn't have made any mistake because all it did was just go up. This was a very aggressive uptrend. But once the trend line broke, no trends last forever. We started a very aggressive drop as well. From 140, we dropped all the way to 92. And then we started another uptrend, another downtrend. Actually, I have another trend line on Peloton. You guys can see this, right? I'm actually plotting my next trade already. So Peloton, and let me just extend this. I already have an alert set for Peloton, right? So you guys can see this, right? Right now, it doesn't look good because it's going to break the 98 level again. It broke the 100 again, but there's still some value here on Peloton. Okay, so as a homework for you guys, just you guys should just go practice what you learned, look at some stock chart, try to make sense of, draw some trend lines, draw some support and resistance, and actually plan for the day tomorrow. Trade for tomorrow. See what chart you see, and you don't have to use real money. Try to see if try to form an idea and make sure that idea is actually working out tomorrow. Because the more you do that, the paper trade, do whatever, that's how you're going to learn. Okay. I hope you guys enjoyed this lesson, and now it's time for questions. Thank you.
Elena, so 2250, 2300, 2350, 2400, those big whole numbers. Like Tesla 750, Tesla 700, Tesla 650.
Yep.
You're typically going to see a lot of demand around those numbers.
All right. You guys do us a favor and leave us a testimonial of like 2 sentences or whatnot in the Discord chat about what you learned, candlestick support and resistance, just so we can see and know what you guys, we want to see what you guys are learning and what you picked up the most. Whenever you get a chance, we'd appreciate that. Hey, yo, Art, what is your stop loss for pin bars in bearish engulfing. I'll be going over that later on in the chapter. I mean, in the course. When will the recordings be sent? They'll be sent very shortly. You know, it takes a minute to download the our video. I'll explain everything. Like we explaining everything. We got 10 more classes to go. Like I said, it's going to get very advanced.
Which trading app do you prefer for barely learning the basics? Thinkorswim is a very easy app to use. I would recommend Thinkorswim. When do you know market is going to reverse up for an uptrend? When you see higher highs forming and buyers coming in and volume is up, that's when you know stock's going to go up.
Jacob, I would get at least the pro plan for TradingView. But if you can afford it, the premium plan is really the way to go.
Nicholas asked me a question. How did you mark all those key levels on your chart? Just have to go back in time. I showed you that 33.25, right? Just go back in time and see where in the past has the stock rejected, which place, what level was it rejected, and you just got to mark that. If you see more than a 1, 2, or 3 points, just mark that as a level. Do that in multiple time frames as well. What are those colored clouds? So there are just EMAs. We'll go in the next class what an EMA is.
A swing trader is a day trader? No. How can I be a part of Aristotle's group chat? Link in my bio on my Instagram. So does RSI matter for us? Yes, I'll be explaining indicators, I believe, next class or patterns. I'm not sure. It's going to be either next class or Tuesday next week. How do you know what stocks you'll be looking into every day? We'll be going over our watch list on day 8. Remember, guys, we got 10 more classes to go. A lot of these questions are about things we will be talking about later in the course.
Stanley, the paid TradingView is definitely the way to go. Even if you can only afford the pro plan, it's way better than the free version.
To get into the Discord chat, it'll be in your email, one of the first emails. So go to your email, search AMU, and then it'll be one of the first emails that has the chat. I like how you guys got different ways of trading. Appreciate that.
Yeah, Karen, we go over, all 3 of us, how we set up our TradingView and Thinkorswim and everything.
Andralo, why did you say disregard Netflix 499 break this morning? So that level actually broke and the stock broke above 500 again. So that's why I said disregard that. So obviously the market didn't think it was a big deal.
Anthony, yeah, I have an entire day about TOS, about the platform.
Use the 4-hour chart for support resistance line always. Use a combination of daily 4-hour and 1 hour. Just see the different time frames, different points of views. At the end of the day, it's all the same price level. Thanks, Shay. What happened with Roku today? What happened? Mike and I took 2 rejects on that.
Yeah, I scalped it 2 or 3 times, actually. We'll be talking about risk management later.
Can we apply TA to crypto? You can, but every instrument is different. So you got to know how that instrument trades and then learn to apply TA to that instrument.
Kylie, yeah, honestly, a lot of the time we do trade the same stocks every single day. We trade high beta names, but we'll be talking about our watch list.
Big facts, big facts. How many hours do you spend each evening to get ready for the next day? Maybe, honestly, it only takes about 40 minutes for me to make a good watch list, maybe 30, sometimes 20. How long does it take you guys?
Probably an hour. Spend an
About
hour every morning.
I'd say 45 minutes, 30, 45.
Yeah.
The watching process takes more time than the actual watch list creation.
Yeah. Already set me up nice on DB. How was 420? We taught AMU first day. That was about it. No drugs or anything. I've been using my phone. Yeah. When should I buy your Discord? After AMU, or like when you start picking up on things? Thanks. I'll be back tomorrow. Appreciate everything. Well, you guys have a great night. We will see you guys same time here tomorrow. God bless you guys. And don't forget to tell us what you've learned. I want to personally see what you guys have learned, and I will repost it on my Instagram story. So, feel free to put your Instagram if you want me to tag you or something. But yeah, God bless.
Good night, guys.
Good night, guys.